Hello everyone, and welcome back. Today we're diving into a question that's on every crypto investor's mind: how do you enter a market when a trend is just beginning? Enter too early and you risk getting caught in a pullback. Enter too late and you might miss the move entirely. Using a professional BTC trading analysis as our guide, I'll walk you through a complete framework for trading early-stage trends. By the end, you'll understand exactly what professional traders are thinking when they face this kind of market condition. Let's start with the core findings. The analysis was conducted on August 19, 2026, with BTC trading around $64,591. The market is classified as an early uptrend, with a trend strength of 0.85 and a confidence level of 65%. Sounds exciting, right? But don't rush in just yet. The report emphasizes three key words: do not chase. While the broader direction is bullish, the short-term volume price signals are flashing warning signs. The trend is strong, but volume is drying up, which raises questions about how sustainable this rally really is. This brings us to our first core concept: multi-timeframe analysis. Simply put, it's like looking at the same object through different lenses. In technical terms, both the 1-hour and 4-hour charts are showing a bearish engulfing pattern, a signal that the bulls may have overextended themselves in the short term. But on the weekly chart, we see a double bottom combined with a bullish harami pattern, which is a strong bottoming signal. So what does this mean in plain English? A short-term pullback is likely, but the medium to long-term bottom may already be in place. Another crucial metric to watch is the taker-buy ratio, sitting at just 33.6%. This indicator measures the balance between aggressive buyers and sellers in the market. A reading this low suggests that the willingness to actively buy is quite weak. Think of it this way: yes, the price is rising, but not many people are actually willing to chase it. The rally is being driven by a handful of participants. Without sustained buying pressure, the upside move will likely face a pullback sooner or later. This is what analysts call a volume price divergence. Here's one of the most important findings in the report, and it's something every retail trader should pay attention to. Right near the current price, there's a dense cluster of both long stop losses and short stop losses, and they're almost exactly at the same level. What does that mean? It means if the price moves even slightly in this zone, it could trigger a wave of automatic liquidations, causing violent price swings. Professional traders call this a two-way liquidation hotspot. For everyday investors, this area is extremely dangerous. Trading here is like crossing a busy intersection with no traffic light. It's asking for trouble. So what's the core strategy in the report? 4 words: buy the dip, patiently. Let me translate that for you: don't chase the price right now. Wait for it to pull back to a safer support zone, then enter a long position. Why should you wait? Because the 1-hour MACD indicator has shown a bearish crossover, and the 4-hour RSI is overbought. The rally has been too fast, so a pullback is likely. By waiting, you get a better entry price and steer clear of that explosive liquidation zone we just talked about. So what does the plan look like in practice? The report's preferred approach is called Plan A. The entry zone is between $63,950 and $64,000, and it requires 3 conditions to be met. First, the price must pull back to this zone. Second, the 1-hour RSI should drop to around 50, meaning it's back to neutral. Third, we want to see a clear reversal candle on the chart, like a hammer pattern. Only when all 3 line up do you consider entering. It's like fishing: you don't yank the rod just because you see bubbles in the water. Position matters, but timing matters just as much. Now let's talk about the stop-loss and take-profit levels, the absolute core of any trading plan. The stop-loss is set at $63,500. Why there? Because it sits just below the key support zone. If this level breaks, the double bottom pattern is invalidated, and the bullish thesis falls apart. On the flip side, the profit targets are set in 2 stages, the first at $64,934 and the second at $65,058. From the entry price, that gives us a risk-to-reward ratio of roughly 1 to 2. In plain terms, you're risking $1 to potentially make $2. In professional trading, that's considered a solid. Position sizing is absolutely critical here. The report clearly recommends allocating only 1% to 1.5% of your total capital to this trade. One of the most common mistakes retail investors make is going all in right away, putting everything on one trade. But professional traders understand that markets are uncertain. The classification confidence here is only 65%, and volume hasn't confirmed the move. With a small position, if you're wrong, you live to fight another day. With a huge position, one mistake can seriously hurt your account. This isn't being timid, it's being smart. Let's recap today's key takeaways. First, the market is in an early uptrend, but the volume isn't supporting a direct chase. Second, multi-timeframe analysis shows short-term pullback pressure, but the weekly bottoming signals are constructive. Third, the preferred plan is to wait for a pullback to the $64,000 area, confirm stabilization, and open a light-long position with a stop at $63,100. The alternative is to chase a breakout above $65,100 on strong volume, with a stop at $64,000. Fourth and most importantly, position size must stay under 3%, and you must honor your stops without exception. Trading isn't about being. If I had to summarize today's strategy in one sentence, in an early-stage bull market, don't chase, wait for a proper pullback to open a small long, honor your stop if it breaks down, and only chase when volume confirms a breakout. Stay disciplined, follow the trend, and respect your risk. Remember, in the crypto market, survival matters more than speed. Thanks for watching today's video. If you found this helpful, make sure to hit like and subscribe for more professional crypto market analysis. Investment involves risk. This video is not financial advice. Please make your own informed decisions based on your risk tolerance. See you in the next one. One more detail worth emphasizing: consider giving yourself a cooling off period. For example, if your position gets stopped out, pause trading for at least 4 hours. Don't rush into the next trade. Why? Because after a loss, emotions run high. The urge to immediately win back what you lost often leads to even worse decisions, a vicious cycle. Step back, calm down, reassess the market, and then decide. There will always be another opportunity, but your capital is finite. Protect your account first, and you'll live to see the next real setup. Let me wrap up with the key takeaway from today's report: trends wait for signals, and signals wait for confirmation. The trend doesn't show up because you predicted it, it shows up because the signals confirm it. And signals aren't flashes of intuition, they come from solid technical analysis and disciplined execution. For Bitcoin in this early uptrend, the smartest approach is simple: wait for the pullback, keep your position small, and respect your stop-loss without question. If you can do that, you've already surpassed most retail traders in both mindset and professionalism. Thank you all for watching. I hope today's session helps you build a more rational approach to trading. In our next video, we'll check back in on the market, we'll see whether the plan from this report actually gets triggered, and how we should respond. If you found this useful, feel free to hit like and subscribe, so more people can learn to invest with a clear head. See you next time. Risk warning: investment involves risk. This video is not financial advice, ***.